Hello there, finance friends. So we've come to a great point in the class. We've learned a lot of basic ideas. We've learned to cultivate awareness. We've been thinking about systems and we've learned, basic day-to-day skills. And now we're at a point where we can actually cover one of the more important topics. In fact, one of the topics that most people think of when they think of personal finance, which is investing. Okay. So in the next two lectures, we're going to talk about investing. The bottom line is simple. Investing builds wealth over time by allowing money to grow faster than inflation. Following simple guidelines can make investing painless and help you become wealthy without having to beat the market. Okay. So this is a really important idea. We're going to argue this along nine supporting prongs, nine supporting arguments. And as you can see, we're going to sort of start at the big picture, take some big top level things, and then slowly drill down so that by the end of this discussion, you're going to understand index funds, which is a great tool to help you. You'll understand what index funds do and have some strategies under your belt that you can put into practice so that you can begin investing right away. Okay. So, with that said, let's jump in. And we're going to again start at the very top. We're going to assume no knowledge except for previous ideas about systems thinking and some of the basic mindsets of personal finance. So, what is investing? Well, when we talk about investing, let's return back. At the beginning of our discussion, when I was kind of laying out for you at the beginning of our class, of our time together, when I was laying out for you the idea of what personal finance is, I introduced to you this idea that there were four buckets of economic activity. And we said that to be really good in personal finance and to start thinking and build the awareness and intuition of a financially literate adult, of a person who has a wealth building mindset, we needed to do four things. We needed to earn money. We need to use it to control it wisely on a day-to-day basis. We need to grow it, and we need to protect it. So these are the four buckets of economic activity. These are the four ways that I want you to think about how do you conceive of running money, handling money, thinking about a long-term journey or process. So we're going to earn money, we're going to use it or control it on a day-to-day basis, we're going to grow it over time, and then we're going to protect it. Investing takes us right here to our third bucket. Because at its core, investing, while it involves lots of different skills and lots of different mindsets, it's got one fundamental goal. Investing is designed to grow the money that you have. To grow the money that you have. And we're going to grow that money in order to achieve our long-term goals. So it's also very important that when we think about investing, we understand that investing is ultimately rooted to our goals. We all have goals in life, and those goals should align with our life values. Investing is a way to think about how can we put a price tag on those goals and then save to make those goals a reality. Okay, so investing is about achieving goals, and investing, as opposed to, let's say, saving, investing is a long-term process. When we think about investing, we're not talking about anything quick. This is not a get rich quick scheme. It's a thoughtful, ongoing, long term, if it's done well, boring process. Okay. When we invest, ultimately, what we're doing is we're buying assets. So when we say that we want to grow money, you say, investing is about growing money. We achieve that by buying assets. So investing is about taking your cash and about buying assets. And these assets, this is what we're going to talk about in this lecture. These assets, this is what grows in value. So you're not leaving your cash under a mattress and hoping that it magically multiplies. You're using your cash to buy assets, and those assets will grow in value. Okay? Now, this is really important Because once we start thinking about it that way, then we also have to understand that investing ties in to our discussion of systems. Okay. You can't separate investing from all the other aspects of personal finance. It's a system and it ties in. So, for example, we had said in earlier lectures on budgeting, for example, that you bring in some income and that we want to deploy money in different allocations. And I taught you a simple model, the 50, 30, 20 model, where 50% of your income goes to obligations, the things that keep your life and your reputation intact. And 30% go to luxuries, the things that bring some variety and aesthetic beauty and fun to life because we're humans and we need that. And then 20% was for saving and investing. So notice that systems thinking wise, it's this money here, it's the 20% of your income that you save. This is what has to go to your investing. And that implies, therefore, that to be able to invest, you have to always be running net cash flow positive. Okay. You have to be bringing more money in than you spent out. You can be an investing genius. You can have all the right ideas and all the right strategies. But if you don't have cash available, you can't invest. So we have to think back to cash flow control and to budgets and to systems and to the strategic allocation of our money in order to have a pool of funds that we can then deploy to buy assets. Okay? We also will find something really interesting when we talk about the systems. Investing is also really the core growth engine in this idea that we have of building a long-term wealth building machine. Okay, investing is really the key, and investing is characterized by feedback loops. So let's take a look at this. Let's say that we have some income, okay, and then we use that income to buy assets. So we use that income to invest. Well, those assets over time will grow in value. They'll generate dividends and maybe rental income and interest payments and other forms of income. So when those assets grow in value, well, they generate income. And now we see our old friend, the feedback loop, right? And now we have some income. And if we pour that income in to buy more assets, we then generate more value and we get even more income. And this process continues. And this arrow down here, this feedback arrow, gets fatter and fatter and fatter as our investments generate more income so we can buy more assets, and the cycle gets great. That's a virtuous cycle, and that's wealth. Okay. So it's a systematic way of thinking. Ultimately, I think we can summarize investing by 8 principles. And here they are. So take a look at these things and let's really think about these ideas in the context of a system. Okay. Notice that when you read through this, in addition to the systems thinking up here, we've also kind of reiterated a few earlier points. We're going to talk a lot in this lecture about automation, because automation is always greater than intent. And always we know that systems will always trump emotion. So we're going to be thinking about a systems lens. We're going to be thinking about a wealth lens. We're going to be thinking as financially literate people who understand systems theory. Okay. So with that said, let's get into it. And let's first start by taking a real top level philosophical view. When it comes to investing, there are 2 primary philosophies that investors sort of follow. There's an active investing philosophy and a passive investing philosophy. Okay. Let's start with the active philosophy. When we talk about the active investing philosophy, we're talking about an idea where investors think that they can beat the market. When we talk about active investing, we're talking about a philosophy where investors say they can beat the market. Now, we want to think about what this means, okay? Here's the simplest way to think about it. When we say beat the market, when we say the market, we're talking about the average return of the whole stock market. And for this, we introduce an idea called the index, okay? Don't really overthink index. Just think of index as like a collection of assets that represent a bigger market. You can think of it this way, a simple analogy. Every individual investment, every individual stock is like a tree. The index is the whole forest. Okay. Within that forest, again, there's individual investments. Those are the trees. And some of those trees are giant redwoods that are huge companies, and some are little tiny shrubs, which are tiny companies. And over the course of time, some of those assets will grow big and flourish, and other ones will wither away and maybe die off. So we have the individual assets, those are the trees, but we have the index. So the index is the whole market. And oftentimes when we hear people say, you know, the market is up or the market is down, they're not talking about one individual stock or one individual company. They're talking about the market as a whole, which is encapsulated by the idea of the index. Some of the more popular indexes you may have heard of include NASDAQ, which is an index of like tech funds. But one of the big ones that we talk about in this class is the S&P 500. The S&P 500 is the Standard and Poor's 500, and it is an index that is composed of the 500 largest companies in America. So when we talk about the S&P 500 index, we are talking about this collection, this basket, this forest of 500 individual stocks, of 500 individual companies. In any given year, some of these companies will do well and gain in value, and some of them will stay sort of level and hold, and some might actually kind of do poorly and decline in value. Okay, it's not that every stock goes up or every stock goes down, but overall, the whole forest, that's the index. So when we say that the market is up, that the S&P is up, we mean that the forest is thriving as a whole, even though an individual tree might be growing while a couple of trees are dying off. Okay, so that's what the index is. Taking it a step back, active investors think that they can beat the index. And to do that, they often engage in very frequent buying and selling. In other words, an active investor is assuming that by buying and selling consistently all the time, moving, they can sort of beat the overall market. They can gain an edge. Notice that in addition to frequent buying and selling, which assumes that you have an information edge that other investors don't have, active investors also engage in timing the market. We know that the market has ups and downs and periods of volatility. Active investors believe that they sort of know or can predict or chart or otherwise determine when the market or when an individual stock is kind of at a peak and a high or at a low and a bottom, and they trade on that momentum. Okay, so that's the active investing system. Here's the big thing to understand, which we'll tie into a later lecture or a later part of this lecture. Because of the active nature, the frequent buying and selling, active investing has a very, very high fee structure because you have to pay fees every time that you buy and sell. And if you get a financial advisor who's an active philosopher, that person is going to buy and sell and charge you a bigger investment fee. So active investing is characterized by higher fees. On the other hand, we have passive investing. And passive investing is much simpler. Passive investors do not want to beat the market. They just want to match the market. In other words, passive investors are content to simply earn the same return as an index generates. Earn the same return as an index. To kind of put this in context, over the last 10 years, the S&P 500 has had an annual rate of return of about 10.97%. So that's been the rate of return. That's been the growth rate of the S&P index over the past 10 years. A passive investor simply says, I'm content getting 10.97%. I don't need to beat it. I'm just going to invest in a way that mirrors the index, that mirrors the market. And the tool that they use for this is an index fund. Now, we'll be talking about mutual funds later on, but just for now, understand that an index fund is a type of mutual fund that simply attempts to mirror the index. And therefore, when you buy an index fund, you're basically saying that you're content to earn the same return on your investments that the market is earning as a whole. So, in other words, a passive philosophy simply attempts to mirror the market. Now, you're going to have to make up your own mind as to which is the strategy for you. But the research, the historical data is pretty clear. You cannot beat the market. The research is actually shocking in the vast majority of professional investors, people who are investment professionals for a living, they do not consistently beat the market over time. So if those guys as professionals can't beat the market, you really need to have the humility to ask, what can you and I as civilians actually achieve? So how about we start off with the idea that, number one, you probably cannot beat the market. And how about we also go with number two, this idea of the timing of it? You cannot time the market. But here's the beauty. You don't need to beat the market or time the market. 10%, 9% return is great. And as long as you're in the market investing, you're going to do great. So how about we say, we know we cannot beat the market and we know we cannot time the market, but how about we give ourselves the permission to say that's okay? It's good enough to match the market. And how about we live by this little motto? Time in the market will probably always beat timing the market. Time value of money says that once you start investing, the earlier you start, you're good. So that's active and passive investing. You're going to have to make up your own mind on which one works better for you. But know that the data and the historical record strongly supports the hypothesis that you cannot beat the market or time the market. But the laws of personal finance say that's okay because you don't have to build a system. Okay? So we understand that. Now that we understand that, let's talk about asset classes. Okay? Because you're going to have to invest. So when we talk about asset classes, what we're talking about are categories of investments. There's lots of different investment types out there. There's loads and loads, thousands probably, of different little tools, different stocks or bonds or things you can buy and invest in. When we talk about asset classes, we're using the term asset class to mean a category of investments. A category of investments that share similar characteristics. There's a lot of different types of assets out there, but for most investors, the big three asset classes are cash, stocks, and bonds. Cash, stocks, and bonds. Okay, let's talk briefly about those. Cash, we know what cash is. We know that cash is cash and that cash is liquid, and therefore, taking away the effects of inflation, it holds value. If you have a $100 bill today, you're going to have that same $100 bill in a year. So cash is good in the sense that it's liquid. It's fairly stable. And again, we're ignoring the inflation effects for the moment. Okay. That's cash. But the thing is, cash doesn't grow big. The returns on cash investments are typically pretty low. And therefore, it's going to be hard to grow your money over time. Stocks, on the other hand, offer growth potential. When we talk about a stock represents a piece of ownership in a company. When you buy a stock in a company, when you buy a share of Tesla stock, or a share of Microsoft stock, or a share of any stock, you are buying a little bit, a small little proportional share of ownership in that company. You own Tesla stock, you're a little tiny part owner of Tesla. And that means that you're entitled to a share of Tesla's future profits. That's for any company. When you own a stock, you own a little piece of a company, and you're entitled to a share of the future profits that that company generates. And historically, those have been pretty good. So when we talk about investing in stocks, stocks are growth engines. I want you to think about your investments like a rocket. Stocks represent your thrusters, your big engines. They give you the liftoff. The bulk of your growth is going to come from stocks. But stocks also tend to be very risky and very volatile. And that leads us to our third asset class, and that's bonds. Now, when you think about a stock, with a stock, you are participating in the economy as an owner of a company. With a bond, you're participating in the economy as a lender, because ultimately bonds are debt. They're IOUs. So if you buy a share of Tesla stock, you're a little part owner in Tesla. Okay. On the other hand, if you buy, let's say, a Tesla bond, you are loaning Tesla money for a little bit of time. And in return, Tesla promises to pay you interest. And then at the end of the bond's life, which we call the maturity or the term, Tesla promises to pay you back your money. So if you buy $1,000 Tesla bond, Tesla's going to pay you interest every 6 months. And then eventually, at the end of the bond's term, Tesla's going to pay you back your 1,000. Okay. Now, bonds are less risky than stocks. In other words, if you think back about the rocket ship, whereas stocks are your engines, your thrusters that launch the rocket, you can think of bonds as like your stabilizers, your wings that sort of keep the rocket level. Okay. Together, these asset classes make up your portfolio. So when we talk about your portfolio, we're talking about the whole collection of assets that you own, the value of all your cash holdings, stock holdings, and bond holdings. Those are great. That's your portfolio. Your asset allocation, let me spell that again. Your asset allocation refers to the percentage of each of those assets that you have. So if you think about, for example, your portfolio as a big pie, the size of each slice, let's say you had this much in cash and this much in stock and this much in bond, the size of each slice, that's your asset allocation. And this is really important because I want you to think about the fact that your asset allocation consists of stocks and bonds. Well, we know that stocks are risky, and we know that bonds are relatively safe. We know that stocks are risky and that bonds are relatively safe.